Hello, I am Selin Demira. Welcome to the weekly market brief prepared with contributions and research from Yasar Atolye. It was quite a busy week again. The Fed was involved, critical data such as US non-farm payrolls were released, and markets were quite turbulent with tech earnings reports. Let's see what all of this means for you. Let's start with these global developments first. The Fed kept interest rates steady as expected, in the range of 4.25% to 4.5%. But something interesting happened in the decision, didn't it? For the first time since 1993, two members, Waller and Bowman, called for a rate cut, and dissenting votes were recorded. That was quite notable, wasn't it, Burak?
Yes, it was quite noticeable. Especially since these two members were appointed by US President Trump, it led to interpretations such as increasing political pressure on the Fed, or even a shadow presidential race. When Powell avoided making a clear statement for September, the markets initially became a bit uneasy, of course. It seems there isn't a complete consensus within the Fed either.
The real bomb came on Friday, but it's the US non-farm payroll data.
Yes, that data.
The July increase was below the expected 104,000, with an increase of 73,000, but the real shock was the massive downward revisions made to previous months. In other words, the private sector increase for June was reduced from 147,000 to just 14,000. A downward revision of 258,000 was made for the last 2 months. Unbelievable.
It definitely made me realize that the employment market is not as strong as it seemed, and it was seen as a serious data scandal. There were even reports that US President Trump dismissed the head of the relevant statistical agency. So that aspect is also there. These revisions not only change the Fed's course but also show how fragile economic modeling and forecasts are. Of course, this is a factor that increases uncertainty for investors like you. With these developments, the likelihood of the Fed cutting interest rates in September skyrocketed to 86%. Although recession fears have increased, the general consensus still favors a soft landing scenario. That is, the expectation is that the economy will slow down without a sharp crash.
So, what else was in this complicated table? The IMF slightly raised the global growth outlook. On the tariff side, the US and China extended the current situation by 90 days. The EU and the US also agreed to extend the 15% customs duty. This rate also applies to Turkey. Let's take a look at the indexes as well. What did the S&P 500 and Nasdaq do? The American stock markets closed the week mixed. The sales on Friday were particularly noticeable. I think these data and the Fed uncertainty influenced it.
Exactly. It had an immediate impact. As for the technology balances, they weren't actually bad overall. Meta and Microsoft exceeded expectations. Amazon and Apple showed somewhat more mixed signals, but the artificial intelligence investments are still the main theme. Major tech companies are expected to spend over $400 billion this year. That's a significant figure. After these declines, the 6,200 level is an important support for the S&P 500. It is both a psychological threshold and a place where buyers have previously entered during past declines. For Nasdaq, a similar situation exists around 22,650. We'll see next week whether these levels will offer buying opportunities.
This interest rate cut expectation was probably reflected in the most liquid US Treasuries. Yields dropped sharply.
Absolutely. Right after the employment data, the 10-year yields dropped by 0.12 points and the 2-year yields by 0.21 points. These were very sharp movements. This is related to the market almost expecting a rate cut in September. In the short term, this situation could support bond prices, of course. But some analyses suggest that due to potential credibility loss of the Fed and government policies, there could be upward risks in long-term interest rates. So, short-term and long-term expectations seem to be diverging a bit.
Let's talk about the Turkish markets. The 265 resistance on Borsa Istanbul was tested again, but couldn't seem to be broken.
Yes, that is a challenging region. The index pulled back from there. The levels of 10,800 were also tested in TL terms. Unfortunately, the difficult outlook in the economy continues. The increase in bankruptcy filings, that is, companies' debt restructuring applications, and the decline in purchasing power, is noteworthy. Some even say that the rise in motorcycle sales could actually be a reflection of the decreased purchasing power. An interesting perspective. In this environment, the current levels of the stock market might seem expensive to some. Foreign investment was good in July, but we saw a slight slowdown in the last week. While the central bank's foreign currency purchases continue, domestic demand for foreign currency is mainly driven by companies. Also, the extension of the 0% withholding tax on government bonds until the end of the year was an important detail.
What is the situation with precious metals? I think it was active for gold investors.
Yes. After the data, it rose rapidly and approached the critical resistance zone around $3,360, $3,370 per ounce. We know it has turned back from here in the past. Now, whether it will break through this time is important. If you have a gold position, you need to monitor this level closely. Silver, on the other hand, fell more sharply than gold, dropping below $37. It has entered an oversold region. Due to its long-term potential, these levels may be seen by some as a buying opportunity.
It seems that not many smiles came from the crypto world this week, does it?
Not considered significant. Yes, Bitcoin pulled back to the support level of $113,000. Ethereum and Ripple experienced similar declines. The general opinion is that these drops might be an opportunity for gradual buying. There are interesting developments in the fintech sector as well. Platforms like Robinhood are now focusing more strategically on crypto and blockchain, not just buying and selling, but also developing stablecoins and new services. It seems there is a transformation happening in this area.
Well, finally, let's look at the economic calendar. What's coming up next week?
On Monday, we have July inflation data. A monthly increase of about 2.5% is expected in the market. Other data, such as foreign trade and the real exchange rate, will also be released. Globally, all eyes will again be on US inflation data. Of course, there is also the Jackson Hole meeting at the end of August. It is a platform where Fed presidents can give important signals. Therefore, it will be closely monitored.
It seems we have just left a rather volatile week marked by data revisions and central bank messages. Markets appear to be trying to find their direction for a little longer.
Absolutely. The question that remains in mind, and perhaps you should also consider, is this. Were these surprisingly large revisions in US employment data really just a calculation error, or were there political reasons involved? This situation raises an important question about how it should affect confidence in economic data and consequently your investment strategies.
Let's leave you alone with this question then. See you again next week. Wishing you a profitable week.